Well, good evening, everyone. Welcome back to the channel. So this evening we're going to continue the series again with another one of our favorite funds that happens to come from the QYLD family, RYLD, which is actually paying a whopping 13.3% dividend over the last year. So I've got the spreadsheet ready, and let's go ahead and dive right in. So what we're going to see, this one is pretty close to some of the other ones in terms of the top tier of the list. Let me just kind of zoom in here. Let's see. Okay, so RYLD. So again, like we say, you make $1 million somehow, whether you make it working your whole career, whether you hit a mini lotto, whether you know, make it investing or however you make it. We're all resourceful people. So somehow in this example, somehow you've come up with $1 million. And so what you do in this example, you take the $1 million and put all of it into RYLD. And here's what would happen. So at the current share price of $18.58 per share, you would have 53,821 shares. And the current dividend is actually $2.48 per year. And that's adding up all 12 months of dividends. So it's on average about 21 cents per month in dividends. And I'll show you the exact dividends amount from Yahoo Finance in just a second, but we're going to go through these specs here real quick. So the total payout, like I was saying, is closer to what we've seen on our top funds. I think our best one in the series was 175,000. This one would pay 133,000 per year if you did this, which would be 11,000 per month. Or I even go further, per day, $360, which is awesome. Like I said, this is more than full-time income. Now, a couple scenarios here. If the dividend dropped to 20 cents per month, you would take in, ooh, I did something crazy. Oh, you know what? This is still based on the icon one that I did. So if it was 20 cents per month, I've got to take this times 20. So you'd be at 129,000. If it was only 25, or if it went up to 25 cents per month, then you would be at 161,000. So it's a 13.33% dividend, which with a little bit of rounding, 133,000, and that's actually pretty easy to figure out. You think about it, $1 million, 13.33%. Some of you savvy viewers could have figured that out in the first probably 10 seconds of the video. So, spoiler alert, 133,300 per year at that rate. Now we're going to look at Yahoo Finance and determine how stable this fund actually might be. Because when I first got into the QYLD about a year ago, this was not, RYLD and XYLD are not two of my favorites, and I'll show you why, but I'll probably save XYLD for another video. But right now, we're just going to stick to RYLD because that's what we're talking about. So if we look at Yahoo Finance, and let's see here, Yahoo Finance, Russell 2000. And okay, here is the fund we're talking about, RYLD, is indexed for the Russell 2000, which is not a top performing index. But you can see since March of last year, the dividends have ranged from 24 cents per share and as low as 18.7 cents per share. So you can see pretty much hovers around our average that we said of 21 cents. So it was 24 cents and 23.5 cents in April, and then last May, 21, and then it hovered between 20 and 21. Then it dropped to 19.6, 19.5, 19.9, and so on. And it's held pretty much steady from there. Now, there haven't been any capital gains or stock splits because this is an ETF. So these are going to come up blank, as you'll see. But the other thing I want to look at, going back to the dividend screen, now the market got pretty beat up the last couple of days. And if the conundrum with the market, it seems like we haven't changed anything from last year. So we're still in the same situation where we have high inflation and high employment. So when the jobs number comes out tomorrow, it's kind of like a conundrum, or kind of, I guess you'd call it irony, because a good jobs number means that the Fed's going to raise interest rates to the maximum, because a good jobs number means that the job market's not cooling off, which means inflation is not cooling off. Whereas a bad job number may mean that the Fed may stop, because the Fed's duty is to keep the economy stable, to keep things at a stable level. And obviously, they've let inflation get out of control. One could argue whether or not that was their fault. Obviously, Congress and the executive branch are in charge of spending, whereas the Fed is in charge of monetary policy. So one could make the argument that the Fed wasn't so much in charge of it, but they do print the money. But Congress decides how the money gets spent. So inflation, has for the last couple of years, or really the last probably 15 months or so, has become a big, big problem in the United States. And right now, what the Fed's doing, raising interest rates, not to get too off topic here, because we are talking about dividend ETFs, but the increase in interest rates is not stymieing inflation. And it's to the point, like me personally, I don't think the raising of the interest rates is going to stymie inflation, because there's some very fundamental problems in our economy. We're not producing enough domestic energy, for one thing. Supply chains are all screwed up, and a lot of people have not returned to the workforce. So there's things that are driving inflation, and employers are having to pay higher wages for people to come back into the workforce. There's so many things that the pandemic really messed up. So, because the whole thing about government spending and all that, I mean, we've been spending so much money for forever, but we didn't see inflation. The last recession that we had, we didn't see big inflation. And I get into a lot of this in other videos, so I don't want to turn this into a rant about inflation. But long story short, the market is probably going to drop again tomorrow, because we're expecting a good jobs number, which is counterintuitive that the market, or that a good jobs number could drop the market. But that's why, because a strong jobs market is a signal of continued inflation. So anyway, back to the RYLD. So dividends only, I just want to look at lifetime dividend payouts. So let's see here. So over the life of this fund, we have had, actually, it looks like it only goes back to May of 2019, and it's held pretty much constant in terms of what it's paid out. Hasn't really fluctuated too much. Now we're going to look at the price of the fund, and let's look at how we're doing here in the comment section. No comments. Feel free to comment for those of you watching. That always makes the experience much better. But in terms of the fund's performance, so really this fund isn't that old. April 2019, we were $25 a share, and you see this big cliff here and the drop. You can guess what that was. That was the pandemic when the market dropped. So that dropped to $15.69, would have been a great buying point from there. And then peaked out again over $25, July 2021. Don't we miss those days? And then its last peak, $25.70, November 2021. And then it started coming down, and it's been slowly dropping since. So this one, really, I guess they're about the same, but I like the QYLD better just because it's the NASDAQ, index for the NASDAQ. But this one, really, the dividend payout is pretty close to it. Expense ratio is 0.6%. For the year, we're up 3.53%. That's just because we had a great January, but we haven't seen these trends continue since then, unfortunately. So it looks like we're pretty much back to how we were in 2022. So with that being said, yeah, there's not a lot of history on this fund, but you see what it's paid out in dividends. So then let's go back to the spreadsheet, and I'll just review over our top ones so far, because I'm going to probably conclude the series here. Well, if I ever run out of funds to talk about, then I'll conclude the series. But let's just kind of look over, because this one does rank towards the higher portion of the scale when it comes to the actual payouts. I mean, 133,000 is awesome compared to some of the other ones we've looked at. Like Icon Enterprises, well, that was 147,000. Golf was 127,000. TLTW was 199,000. QYLD, actually, RYLD is beating QYLD in this example. Our first one we did, SVOL, 175,000. That's probably my favorite one overall. JEPI was 115. SCHD was only 33,000. But the reason so many people like SCHD is because it's had a lot of capital appreciation, which you also do want to look for in funds. But really, that's pretty solid, the RYLD, in terms of the 133,000. I mean, that's, I mean, I would take that certainly, but and the price isn't that much higher. It's actually lower than the SVOL. So it's definitely a viable option to be on this list, and definitely worth considering. So anyway, if you like that, please remember to like, comment, and subscribe. Thanks so much for tuning in. For those of you who tuned in live, wanted to keep it shorter today since the last video was over 40 minutes. So thank you all. And for those of you that are going to watch in the future here, hope you enjoy. Thanks again. Have a great evening.